and grow and scale your property portfolio, then you're going to want to watch this video. There is a big frustration that many business owners have when it comes to obtaining finance, because we are in a country whereby the banks are very, very conservative and they don't really like lending to small business owners because running a small business is inherently. I used to have this same frustration until such a time as I discovered the rules in which the banks use to be able to determine whether they're going to lend you money or not. And ultimately, you're going to find yourself in one of three positions. Position number one is that you go and try and access lenders and they say, hey, sorry, computer says no, better luck next time. Outcome number two is that you are able to obtain finance based on your current financial position, and that allows you to achieve your particular goals, whether that be buying an investment property or funding the growth of your business. Or three, you find yourself in a position where you may not be ready to get funding right now, but you are able to understand the levers that you need to pull financially, either personally or in your business, to be able to bridge the gap. And then when you come back upon achieving those particular financial results, that you know exactly how you get finance approved. And the idea is we want to remove number one from the equation and we want to focus on two and three. So let's talk through this. As a business owner, if you're looking to obtain funding, you need to understand the two core mechanisms that banks use in order to assess your borrowing capacity. Mechanism number one is your equity position, and mechanism number two is your servicing position. So let's talk a little bit about equity. Now, banks only care about equity. They ultimately want to ensure that they don't lose money. And the only way that they ensure that they don't lose money is to ensure that you have adequate equity that they can secure against, to ensure that in the event that you default on the loan, that they can be made whole. And that equity is going to form one of two things, potentially both. One is going to be usable cash that you have available to contribute to a particular deal. And secondly, usable equity that you have available in existing properties that you can contribute to the deal. Now, usually banks are going to have a loan to value ratio that they are going to require in terms of what you must contribute to that deal in order to ensure that they satisfy their risk appetite. Now, if it's property, so for example, you're looking to buy an investment property, they're usually going to want a 20% contribution of equity to that particular deal. If you can contribute less than that, they are going to charge you lender's mortgage insurance, which is basically an insurance policy that protects them if you default. Okay. And of course, if you're looking to buy a commercial property, then that is usually going to be a 30% contribution. If you're looking to buy a business, in many cases, it's going to be a 50% contribution. So your equity position is usually going to be the first consideration behind whether you're going to be able to achieve the particular goal or objective. And the more equity you have to contribute, usually the less risk you are. And it also means the less interest that you're usually going to pay. Two, the second mechanism is servicing. And what we need to understand is that the banks have an algorithm in which they assess your income versus your expenses, whether that be personally or in your business, for determining the maximum amount of debt in their eyes they believe you can afford in the current market. And they usually will price in a 2 to 3% risk buffer that if rates go up, do they still believe that you're going to be able to afford to fund this debt? Okay. Now, obviously, when we're in a high interest rate environment, that risk buffer is like, okay, well, if current interest rates on, say, a residential mortgage are 6%, if you're looking to do something more risky, they're putting a 2% buffer on that. So they're assessing your ability to repay that debt at potentially an 8 or 9% interest rate. So, what's important here is that you need to understand, how do they look at your income? And your income comes in multiple forms. So, there is profit from the business. That profit isn't just one dimension of profit, it's profit that's been distributed, but there's also retained profits. Then your salary, how much salary are you taking? Is there bonus that's structured? And what is the existing expenses that are in particular entities? And how do those banks look at those expenses and potentially liabilities that you have inside those entities in order to determine your surplus? And then how do they assess that surplus by their servicing rules? Every single bank is different. So, for example, some banks are going to allow you to use retained profits that you might have in your business, but they're also going to consider any debts that you've got inside that entity. Whereas other banks will look at your consistent salary distributions And as long as your businesses are profitable, they will ignore any existing debts that are within those business entities. So it's about understanding how do you work with a lending strategist that can help you navigate these rules because they change all of the time, that can help you develop a finance strategy and then work with you in order to either get the approval now or map out a plan to get there, which is the next phase. So, in an ideal world, we want to be able to get approved for finance now, right? And that's the ultimate objective. But the reality is, for many of us, we may not have the financial position, and that usually happens for a couple of reasons. Reason number one is that your accountant has been telling you to optimize your reduce your tax, which means that you have not been showing enough income. And the reality is, if you don't show income, then the banks aren't going to want to lend you money because they don't think that you can service the debt. Okay. So usually what we need to work out is, well, okay, we've just finished your financial year. What was the profitability? What was your servicing? How did you stack up financially for that particular financial year? In an ideal world, we would have had this conversation before 30 June, and we would have said, hey, this is exactly how much profitability you need to show, or how much you need to distribute, or how much you need to pay yourself as a wage in order to get this particular loan approved. And either we have the ability to pull those levers now, fantastic, we do that, or we can't, then we enact a plan to allow us to get to that point. So let's say, for argument's sake, you say that you want to go and buy an investment property that's going to cost you $1 million. It needs $240,000 in equity, plus stamp duty, which you have an existing property, so you can cash it out. And in order to borrow that extra $1 million, in order to buy this property, you need to show a personal income of $300,000. And as it stands right now, you're only paying yourself 200,000. So we've got a $100,000 gap. Well, we've got to work out what are we going to do in the business to be able to pay ourselves that extra $100,000 in order to get that loan approved, and then how long is it going to take us? Because you either get the shits like Laurie here and get frustrated because it is super frustrating and just accepting the rules are what they are, or you understand the rules and you start playing them to your favor and start understanding how do you proactively work towards using those rules to your advantage. So, if you're a business owner, you're doing over 7 figures, and you want to continue to grow and scale, and you want to understand these rules of the game, jump in the link in my bio, complete the performance scorecard, and let's have a conversation around how you take this to the next level.